Good day, everyone. How's everyone doing? Hello, Galaxy Arena. I just made 10 million in Hong Kong gold, like Gordon Gecko did on the beach. Not kidding. It's not April Fool's. No. Hey, Brock. Hey, bro. All right, let's take a look around. So we have NFP tomorrow, right, guys? So I don't know how much position risk you want to take into the number. My thoughts, like what Blake says, you imagine what possibly could happen and how you would execute under that scenario. Um, what I would like to see actually is dollar strength to fade. I looked at the euro. Remember, it was a turnaround Tuesday trade around 1730 and went to 1710, and it really didn't pay much, at the most maybe 30, 40 pips from Tuesday. We have put in a higher low here, but these RSI readings aren't ideal. I mean, we diverged, but just imagine if we made one more low back down towards 1680, 1650. This TF will most likely stay above 30 this time. Okay, and then when you go the weekly chart, and been talking about it with the Eagles, and Blake's been talking about it too, is you could kind of imagine that this is a left shoulder and a head, and the neckline comes in down here around 16 even. Then you could get a shoulder back towards 120, and that's going to measure all the way down here. What I'm thinking though, shorter term, and you could see we're diverging on the 4 hour too. It may just come out of the hole. In fact, tomorrow with the NFP, I remember when I was on FX Street, someone came to me after the NFP and said, Dale, I bought the euro and it was a weak number, and euro rallied 100 pips, and I took it. And my response was, great guess, because that's all it is a guess on how the market's going to react to the NFP. And that's really, it's not trading, just, predicting what the market will do. I think the trading aspect comes in after the initial reaction, and have your areas in mind and a narrative in mind. So the narrative I have in mind, and I don't know if I'll have a chance to do it, maybe we're just going to turn up from here, would be to fade dollar strength on a strong number tomorrow, is what I'm thinking. You look at the Dixie here, I know it's coming off a little bit, but you still have, look at this high on the 4 hour, right? What kind of high is that? And then after the quiz, anyone know what kind of high that is? I know Scott Henderson knows. Brock, do you know? Yeah, Alan knows. All right, so what's the implications? Yeah. What does it imply when you get a confirmed high? Yes. Probability, not for sure, because there have been exceptions. In fact, big exceptions. So, let me show you one. One of my guys I work with asked me about this. How about this? 1 hour. Look at this. What kind of low was this in the DAX back here? See, you had a confirmed low, but it actually turned out to be the low, right? So we're in a business of probabilities, and probabilities mean there are always exceptions to the rule. Something may work half the time or 60% of the time, but nothing 100%. So, this confirmed low, yeah. And they're not, maybe they're not outliers. I've never done the back testing. I don't know how many. There have been many I've realized, and sometimes I get into trouble because of my belief in it, and that's when you have to give price the benefit of the doubt. You could try it, say, well, I'll sell a rally and see if we get another new low, but if it's, you know, starting to break out through key technical areas, you've got that exception. So, you know, everything you use is about probabilities. I don't care if it's Elliott harmonics, everything. So that's kind of what I'm thinking going into Good Friday tomorrow. You know, I'm not sure if I'm going to be here. I'm going to see how I feel when the alarm goes off at 4 tomorrow. But it could be an interesting day with the U.S. close. And I may have an interesting story to share about Good Friday. So Blake, VIX is 18. S&P is starting to do the dance, trying for the BRN, big round number, 4,000. You know, and it did it with the dollar being fairly strong. So that was, you know, I think if it's got a big dance to the upside towards 41.40 or so, that it would make sense to me that we get some type of let up in dollar strength during that phase. Okay. If we don't, it's not going to be much more than maybe 40.30. A lot of people are looking at. Anyway, so the degree that the dollar corrects, I think, will have an impact on the dance above 4,000 S&Ps. That's all I have for you guys today. Any questions?
Yeah, no, I was going to say, I think it's a good observation that 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 DSI on the VIX is as low
Oh,
as it
yeah.
is. There's a lot of people calling for a much lower VIX. I mean, in this environment, but they've been doing
Really?
that for a while, right?
What are they looking for? Like 15 or 16? What kind of numbers are
Well,
you
you're
hearing?
you're looking for a return back to 10,
Oh, wow.
right? I mean, when you have stocks at all-time highs and every
That's
market
where it
continue,
should be. Yeah.
that's where it should be.
Yeah.
And so everybody thinks that volatility should fall from here, but that's been the call for months, and we're just not seeing it. And I'm surprised. You know what? I was just looking around. I think Greg is coming in today. Is he coming in the last half? Uh,
I have
he's
an
not.
interview.
Huh?
I Today, Grega,
No, he should. I think he's coming.
for the first half.
Yeah, I thought. Well,
Yeah, he was asking if he's going to come in now or on the morning edge.
oh,
There,
oh,
no.
oh, oh, yeah. Okay, that's what he was asking. I'm sorry. That was like I was just asking if he's coming in. So, if he's not, that's fine. We'll talk to him on the morning edge then. So anyway, for some reason, first of all, I didn't sleep very well last night. It was one of those toss and turn nights. So if I
Yeah.
if I sound a little loopy, that's probably the reason why. But no, I was thinking that he was coming in during this time frame. So that's why I was asking. But
So we
anyway,
finally filled this gap, Blake, on the VIX here. It was 1820, and look at all the attempts to fill it. And I think we've done it now at 18. Yes, we filled that gap.
yeah,
By
let's
the
say.
way, Blake's going to be here. Sorry, Blake. Greg is going to be here in 5 minutes.
Okay. All right. Sounds good. Thanks. And thanks, Del. And you know what, Dale, as you're pointing out, that gap, yeah, that comes in
1820, I hit.
1820. So we filled it.
Yeah.
So we've satisfied it.
Yeah.
So now that we've satisfied it, we can go straight up.
Yeah. Well, we'll see what a satisfied VIX does.
Yeah. Well, yeah, that's exactly what we
You
should
know,
do.
I'd like to see, if we get to some of these fib extension targets, Blake, and the S&P say, I think Steve had one up around 4140. He was looking at 1.27 and 1.618. Going to be
For the
interesting to
for the
see.
S&P.
Yeah, yeah. So it'd be interesting to see where the VIX is. First of all, let's get above get above and close above 4,000, but it'll be interesting to see where the VIX is and where WTI is, because WTI looks like it has rolled over. It is in a correction while the market's still making new highs. So, maybe the market did, WTI does not make a new high while the market does in the next several weeks.
Yeah, and I think those are good observations, Dale, because wouldn't that be ironic if we close the gap on the VIX finally today?
Yeah. After
and then
what,
the
2
market-
years?
Huh?
Couple years, I think, for it to happen.
Yeah, and
To fill the
then
gap.
then we finally, because after we fill this gap in volatility, well, that not 2 years. This gap is finally filled after. This is post-COVID, right?
Okay, yeah.
So post-COVID
was-
lockdowns, we finally fill the gap in the VIX, and then the stock market peaks. Wouldn't that be interesting?
Yeah.
And
Keep an eye on that.
yeah, and here's the other thing, Dale, and I'm just going to mention this because this makes sense to me, even though it doesn't mean that it's going to happen. I'm just saying the reason why it makes sense. Do you know, for us as guys that have been trading the market for over 20 years, in your case, over
120.
well over 20, and I'm going into my 25th year of trading the markets.
Wow.
But no, that's not the point. The point is, people have been dismissing, especially in recent years, they've dismissed volatility, and they say VIX doesn't matter. Haven't you heard that as being pretty common amongst people?
Yeah. It's broken.
It's broken.
They said the same thing when gold was 200 right before the year 2000. That was the low of the move. It was an archaic relic, only good for like you put on your desk to keep papers from blowing away. Paperweight, archaic relic.
That's
paperweight.
the same argument that we get today, right?
Yeah.
Yeah, I mean, it is
Yeah.
regarding gold, but I mean, here's the thing: is VIX really irrelevant? Maybe it is, but how about if it is so relevant, or maybe it's just coincidence that we actually fill the gap, stocks actually peak, at the same time. That'd be interesting. Now, speaking of gold, gold being
That was a surprise yesterday to me.
It was a bit of a surprise. This is I'm sitting there like you looking at gold, but what held is the 1670 level, and we held I mean that was 1677. We held that and bounced pretty aggressively. I can't get bullish gold until we break back above 1760, but I was impressed with the move in gold that we saw.
Me too. I was surprised.
All right. Well, Greg, I guess, is coming in. Do you guys want to make sure he is he's popping in as I think he comes in as an attendee, so just keep an eye out for him. Oh no, he's here.
And then for the interview, Blake, we have Peter Campbell from at MCM/CT. And Peter does a lot of great work. Our last time he was here, he didn't think that we would peak until we got to about 4,000. So,
well,
it'll be interesting.
Yeah, this is gonna. Well, matter of fact,
Hey, guys.
Greg is here. Good morning, Greg.
Hey, Greg, Wizard, how are you?
It's been a while, huh?
Good to hear your voice.
Yeah,
Go ahead, Blake.
So, hey, we were just talking about S&P 4,000. All of a sudden, we hear your voice. So, what does the Wizard of Waves have to say about where the markets are at? And one of the conversations we were just having, Greg, and this, you might find this interesting because I think you passed us a chart on volatility a couple of days ago, but I'm going to say something really quick that Dale and I were talking about. We were talking about, we've been in the markets for, over 20 years between the, both of us, more than that, but still over 20 years. And people nowadays have just told us how irrelevant the volatility is. VIX doesn't really matter, right? And the
Yeah.
volatility just filled the gap, as Dale pointed out. It's the gap that was created last year post-COVID lockdown. We went into lockdown. VIX spiked above 18. We haven't seen that until today. So we've closed the gap, and we were just saying, wouldn't that be interesting if we end up peaking here at the S&P somewhere around the 4,000 level after volatility finally fills the gap? And it'd be ironic because volatility is quote unquote irrelevant as far as a lot of new market participants are concerned. So anyway, what do you say about the markets here? And I'm going to let you take over the chart so you can show us what you're looking at. But before you do that, I just got to say, hey, everybody, thanks for supporting Forex Analytics. Make sure that you visit our sponsors, Pepperstone Securities. If you're outside of the US and Canada, open your account here to get 4 free months of Forex Analytics. And then if you are in the US and Canada, visit Forest Park FX and they will help you find the broker of your dreams. So what do you say, Grega?
Yeah.
Is it a dating site here, or is it what?
Come on, I had to throw our sponsors in there. They get upset
Of
when
course.
no names. Of course, because they're the ones that make this happen, guys. So make sure you visit them and say, oh, you know, Stelios does a horrible job, but you know, Steve and Blake do great jobs, and Dale too.
Of course.
Where is Steve?
He's coming. He'll be here.
Okay, so I have to
I'm
be
here,
quick.
mate.
Yeah,
Oh no, you're done. You're done, Zo, Grega. Steve's here. Sorry, still a little punchy. Go ahead.
Okay, so I will start with the 10-year US notes. As you know, these higher US yields keep driving US dollar higher. But since we are here at the new start of the month, we have Easter holidays, we have non-farm payrolls report. So there are plenty of reasons why these recent flows can be reversed, at least short term. From an Elliott wave perspective, I see 5 waves down here. Of course, this 5th wave is not maybe finished yet. So maybe there will be more weakness, but eventually we are here in these late stages. Now, if that's the case, then I would assume that the dollar yen would see a pullback, which is here in orange. And as I will show you here on the wave count, I see dollar yen here in wave 3. Okay, now this is a very nice extended impulse still in progress. We can count 5 waves up within this extended wave 3. So I think that this pullback could be very healthy for a next rise all the way towards this 111.70 figure, which was actually spike high when this COVID crisis began a year back. So I'm still looking for this price to be triggered. I'm sure there are a lot of important orders above that level. So I think it's acting like a magnet for now. But of course, to see a pullback, this would be very nice. And this may occur if the 10-year US notes would really rally here into this corrective phase. At the same time, if the 10-year US notes would really look for some support, I think that one very attractive currency could be Australian dollar. Now, looking at Aussie, what we firstly have to realize that still, I mean, there's no reason to fight this trend that it's in play since March. So I'm looking for each pullback as a corrective movement. Why? Because it's much easier for me to analyze the price chart if I label the wave count in the direction of the current sentiment, which is clearly bullish since we have seen this breakout back in 2020. Also, if we look at this monthly chart, just to give you a brief outlook on this one, once again, after 2000 recession, we have seen a nice 3-wave recovery after a great recession here, another 3-wave movement. So I'm looking for similar pattern now away from 2020 lows. So I'm looking this to be only in the middle of this current cycle. Another important thing, I think, is dollar Chinese yuan. Now, looking at this price chart, we are seeing a very nice and strong downtrend, which I believe it's still ongoing. Of course, we have recently bounced away from this trend line, but in my opinion, this appears to be only a corrective recovery. I mean, just saying that we are going much higher from current prices would be quite a gamble. I think that there's much easier to say that this is a pullback and that we are going lower. The resistance, the very nice one, could be this one from back from 2019. It was a March swing low. So I think that this could be a corrective bounce and that eventually we will continue lower. And of course, if that would be the case, again, Australian dollar will be supportive. Also, another thing it's good to mention, it's copper. Copper is still in uptrend. I see incomplete 5-wave recovery. There was wave 1, wave 2, nice extended wave 3. You are now in a wave 4. Now, sometimes it's very tricky to say where wave 4 will end. It might have ended here. It can be still a triangle, or maybe even we can retest the wave 3 swing high here, which can be the case because this 5th wave was extended. Those who are familiar with Elliott waves will know that usually wave 4 of the higher degree will take us back to the area of a former wave 4, which is actually here at the termination point. But when a 5th wave is extended of the previous leg, well, then the support could be already the starting point of a wave 4 rather than ending point. Okay, so generally speaking, I think that this is a correction. If we look to a smaller time frame, 4-hour chart, well, I think it's a correction because the first leg here was clearly made by 3 waves. Okay, but now we are just chopping around here, so it's very tricky. That's why I said earlier that, of course, there can be lower prices retested because it's very tricky structure and still incomplete. But eventually, when this market will start rallying into a 5th wave, I think that, again, that's the timing when Aussie could be very interesting for a bounce. Now, let's take a look on Aussie for a daily chart. Here, we are seeing a very nice pullback. And this pullback, the current one, is a very similar in distance compared to the one that we have seen here in September. You have also this 100 simple moving average right at the 38.2%. If you look to the 4-hour chart, what you see here is a 3-wave structure right at this, very close to this previous 4th wave. So I think it's a very attractive and interesting levels. And as I said, Easter holidays, I mean, always ahead of or around important holidays, there are flows changes. And of course, this can impact the price action. So it really would not be surprised if we see also a bounce here. And if we can rally in 5 waves, and let's say that we break here this upper trendline resistance, I think that this would, a lot of traders would probably find themselves on the wrong foot because everyone are just, when dollar is rallying very strongly, immediately they will change their bias. But that's why I showed you the longer term charts to realize that maybe these pullbacks that we are seeing are just very healthy because let's face it, always when market is at the highs and we want to ride this trend, right, we always say to ourselves, oh man, I would really love to be in here, but after a pullback. But when we get a pullback, we are not that confident anymore. So it's very important to keep an eye on the big picture. And in my opinion, when you have a big uptrend and when you have only 3 waves to the downside, I think that that's the timing when, again, you should be maybe looking for potentially for, or at least be prepared for a bounce. Of course, it depends what kind of a trader are you. I mean, I'm a little bit more patient and with that being said, I want to see 5-wave rise, as I said earlier, here above this trend line resistance, and then we'll look for a potential buying opportunity. Why this type of a confirming price action is important for me? Well, because that's exactly when I will know where to put my stop loss at the end of a wave 4. Of course, I could look for potential entries here and already start scaling into the position, but of course, the risk would be much bigger because I would have to put stop losses probably beneath this 161.8% extension, which is far away. So from a risk reward perspective, I think it's much better maybe to wait on this wave 4 to be finished. Now, also, when we are talking about the Aussie, let's take a look on the Euro Aussie. Euro has a lot of issues, as you know, vaccine supplies, and also we just went to another lockdown here. So in my opinion, Euro has a lot of issues. Australian dollar is doing much better, especially if this type of a price action that I'm expecting will unfold. Then Euro Aussie, I think, could see more weakness. Now, looking at this chart. I'm tracking here wave 5. It should be made by 5 waves. And recently, we just stopped at this 50 simple moving average. It was a very nice reversal each time since actually we have seen this breakdown in at the start of 2020. So I'm looking here to be a triangle. And if Aussie dollar is really about to find a support against the US dollar, then I think that this pair could be very interesting. Also, we have stocks still in uptrend, right? So in my opinion, this could maybe be very nice risk on play if you short GBP or Aussie. Cheers. Okay,
Oh,
so
sorry. You heard me. I'm sorry. I thought it was on mute.
yeah, I heard you.
Sorry about that.
I mean, I didn't know who was. I
That
thought
was
it
me. Oh, sorry about that. It's allergy
Yeah,
season.
no problem. So here we have this triangle, and ideally we will see a weakness here. I'm waiting for this trend line to be taken out and then maybe watch for pullbacks. But as I said, if the US yields would really come to the downside, then I think that maybe Aussie dollar long play would be much more interesting, especially if stocks will remain in uptrend. Let's take a look on stocks real quick here. Firstly, Nasdaq 100 is what I want to take a look at. I covered this one last week as well in a webinar. We said that we have a very nice 5 waves up and a 3-wave pullback. And so far you can see a very nice break to the upside. And what I really like about Nasdaq and why I focused so much on Nasdaq lately is because it was a weak technology sector which had a bullish pattern. So when you have a weak market showing you a bullish pattern, then you can expect that other markets that are already strong will continue to do well, or at least stay supportive. Even if just sideways, it will be very hard for them to come lower. So with that being said, I was looking here for a break to the upside, and I'm still observing for more upside since I'm tracking this 5-wave incomplete bullish move that I think could have here for another 200 point rally minimum, if not more. I mean, if really the previous drop was in 3 waves, then we can also revisit these 2020 highs here. Okay, and of course, some would say that the previous drop was made by 5 waves. But again, as I said earlier, we have very big uptrend. What are the odds that this is really a 5-wave drop and the top, and we are going much, much lower? I mean, that you will probably be more right than wrong if you will always try to label each retracement in a corrective wave if the price action will allow you so. Do we have anyone here? Do we have any questions?
We're listening to you, Grega. And anything else that you want to cover? We have a few minutes.
Here I have some questions. Wonder if Grega ever puts FIPS on his charts.
Yeah,
I do.
Grega?
Yeah.
I'm sorry. I was just going to mention. You were talking about the Aussie.
Yep.
And the Aussie, and I love your outlook on the Aussie. I do believe that, and as I've told everybody here, I think it is a currency pair that I really want to be long on this correction. One of the chart patterns that's very apparent right now in the Aussie dollar is the head and shoulder that's developing, right? But like you,
yeah.
I don't think it's going to complete a head and shoulder pattern, as head and shoulder patterns normally don't complete. But that actually points all the way down to like 71 cents, 72 cents. But I like your chart exactly right there on a dip down towards the 74, 73, cent range. That makes a lot of sense to me because that actually completes like a bear flag pattern that is also trying to build right now. And so I think that if we do make it down to 74 cents or roughly around there, I think it is going to be a good place to be on the long side.
Yeah, and you know what, those head and shoulders pattern, whenever they fail, they are actually very good signals for the opposite side.
Yes, I agree with that. and which is quite a bit, and especially in this market when you're looking for a rally and risk. When you're in a very bullish market, it makes a lot of sense. So
Yeah, exactly. Okay, so we are done, I guess.
So, Grega, if I'm not here to just
We are
poke
not
your
done.
brain, you don't speak a lot.
I do.
Okay, why don't you give us a little bit more?
Oh, don't.
wait,
Oh,
do we
we
have,
have a
do we
guest.
have our guest here?
Yeah,
Ah,
Peter.
is he here already? Okay, then. Okay.
Yeah.
Okay.
Any chance you want to come in 45 minutes?
I will see if I will able to. If not, then tomorrow.
Okay, mate. Good.
Okay.
Thank you.
Okay.
Bye.
Hey,
Thank you,
Grega, thanks
everyone,
for coming in
attention.
today.
Sure, my pleasure.
See you,
Bye-bye.
Wizard.
Bye. Dale.
Take it easy. And Peter, I've made you a panelist, so waiting for you to unmute. Welcome back. Great timing to be talking to you when we were approaching the target you talked about last time we were together. You there, Peter? Unmute. Here, maybe I have to ask you to unmute.
Can you hear me?
Got you, buddy. Got you.
Good, good, good.
Welcome back, Peter. How are you?
I'm good.
So why don't you tell us about how you got caught in a lockdown in Europe and how and how you escaped Europe, the great escape. Welcome back to safety, and a good time to have you here if you want to share your screen.
Yeah, I'm going to do that.
And
just
are
one second.
you implying, Dale, that Europe is unsafe for some reason?
No, but he just wanted to get home and he couldn't because of lockdowns in Europe.
No, you
Yeah,
didn't say.
just one second. I'm bringing up
all right.
my.
You didn't say nice to be back safely. You said nice to be back on safety. That's why I asked.
Oh, yeah, I don't know. I wouldn't want to be locked up here, there, anywhere.
No,
So
with that, I can't disagree at all.
yeah. So good to be at least have the illusion of freedom like we do today. So I prefer the illusion. I'm into denial very big. So Peter.
Yeah, I'm just
know,
loading my charts here to discuss with you guys. And
yeah, I remember when we were talking about time cycles or when a peak might occur in the market. I believe you didn't think, I kept talking about a lot of key guys I talked to that are, into measuring time and cycles were pointing towards April. I think at that time you didn't think it would hold together as long, but you were absolutely dead on about that we would see around 4,000. And, one of your associates who lives in Maui, his name again? Was on with me, or he works with you,
Ed Dowd.
Huh? Yeah, Ed.
Dowd.
And Ed said, when we were breaking back down towards 3,800, I was thinking about you and the call you made, and Ed kind of probably was sharing your thoughts. As long as we held 3,700, it was going to be a correction and a move to new highs. So here we are.
Yeah.
I've set it all up for you, buddy.
Now, are you seeing my screen?
Yeah.
Seeing or my charts at least?
Yeah, we see the S&P with some bands. And
yeah, these are the earnings. Just to start it off with something that entirely doesn't matter, which is earnings. But,
okay, right.
As you can see, my situation is if you hear anything in the background, if you hear birds in the background and stuff like that, I'm at my office on the beach. And if you hear the ocean, you might be able to hear that too. But
where are you?
I'm in Boca Raton area on the beach right now. So I'm literally
nice
on the beach.
Nice. Yeah. You're on you're kind of like
basically
you're a nomad, aren't you? Are you one of those nomads? You just travel around?
No, I'm not a nomad. It's just home. So.
Oh, this is home. Okay. All right.
Yeah.
Nice. Okay, Boca.
But basically, I'll just touch on the lockdown in Europe. I think the situation in Europe is horror show. I've never seen a more manipulated agenda than what they're doing there in terms of fabricating. You know, they'll test people
Okay.
5 times for this
All
and that
right.
and whatever.
Yeah. All
But
right.
the
Well,
lockdown
I'm
is-
just glad you're back. You know, there's, you know, I know that you have a strong opinion about the whole pandemic.
Yeah, I
rather keep
do.
it-
But
I'd rather keep it to the markets, buddy. And
yeah, I agree. with
because,
that.
you know, it's
So,
almost, you know why? It's a shame. It's political. All
Yeah.
right. Public health has
Yeah.
become political. Anyway, so let's talk S&Ps here.
So basically, let's look at the at this situation where we are right now. We have essentially the earnings history for the S&P over a very long period of time, and as you can see, there has never been a bigger disconnect between earnings and the actual valuation of
Of the market. I lost your audio.
all the different earnings rate above them in a bigger way than every market, including 1929. So recently we had something else happen, which is rather interesting, which is that the Nikkei, and I believe
You're fading in and out, Peter. Yeah, Peter, we're having audio issues here.
Okay, can you hear me now?
Yeah, it fades in and out. It sounds like
Yeah,
I know you.
It should be good. It should be good now.
Okay, because it sounded like you were snorkeling, and I know you're near the water, so. Okay.
Yeah, but I'm not snorkeling.
Okay, go ahead.
Anyway, so where we are here is that I believe we discussed this chart last time. We're dealing with the Nikkei breaking out earlier, and it actually looks like the Nikkei wants to do a double top to me. It's broken out several resistances. It might fail earlier, and I want to discuss that because I do think the markets are on a short rope here, but I think that they have more upside than people might imagine because the
Sentiment.
because
Too
the
bearish?
recent highs have been confirmed. So we have confirmed highs and a combination of much more negative sentiment than people actually believe.
Confirmed by what, Peter? By momentum, by advanced decline? What was it that confirmed this last high?
The confirmed, when I talk about confirmed, I'm talking about emotionally confirmed highs. Because to me, how in my process, how trading works is that fundamentals don't matter, put calls don't matter, VIX doesn't matter. All these things don't matter. What matters is they
sentiment.
all have their contribution, but they don't actually drive reliable analysis. What drives reliable analysis is the emotions of people, and if those emotions happen to be connected to price. So if you have a very emotional market and it's successfully driving price, then that's a confirmed high. So you have to be able to measure the emotions, and you have to then be able to say, okay, are the emotions matching the prices? And if they are, then you know that you're not going to finish when emotions match prices. You finish when emotions don't match prices. You have inflection points and dissonances in markets when things are disagreeing, not when they're agreeing. And whether people like it or not, and I'm a bear, so I don't like to see markets, showing that chart that I just showed you before. I think that's a very unhealthy situation. But the reality is emotions are what is carrying price forward. And emotions aren't just people's emotions. They're emotions of central bankers, central planners, bankers, investors, institutions, and analysts. And then retail people and options players and market makers. All these emotions are all driving prices. So,
So prices and emotions are bullish right now because emotions are positive.
well, because the recent highs were confirmed. So the highs, I had thought that it was possible that in February or March, we would see unconfirmed highs. It became very clear in January that it was not possible to see adequately unconfirmed highs, emotionally disconnected highs in February, and it was going to have to be maybe March.
Right.
And
I
now
recall.
it's absolutely not going to be March because it's
Right.
over, April Fools. So I believe that we're coming into
Okay.
a period basically in the next 3 to 6 weeks in which the markets are going to start to change their behavior in a significant way, especially because I'm starting to see people now extrapolating their views out further and further and further. And this is generally something that I look at anecdotally and say, okay, when lots of people decide they're going to look forward and start carrying very, very extreme beliefs, years and months into the future, we're usually running into some issues with reality deciding to fix that. Now, the reason I'm sort of mentioning that is because we're going to come into a cycle soon where the highs are not confirmed. And when that happens, I think we're going to be dealing with some serious consequences. Now,
How will you know that they're not confirmed? What will the emotional?
well, I'm going to show
what-
a chart that will
Okay.
show that. But
I'm just-
I have a number of emotional metrics that I use that
Okay.
help me to determine this. And, I want to just be clear. I'm expecting that April or end of April, early May, we would be creating an emotionally unconfirmed price highs. Now, if we were to create confirmed price highs, I'm going to be continuing to have the same scenario. It just means that the market's going to keep going higher. And I want to emphasize that, we are in what I believe is an extended wave. And these extended waves, you cannot predict a top on them unless you have emotional non-confirmation, in my opinion. And even then, it's not the easiest thing to precisely nail the top, because you need to navigate something where the market can move plus or minus a few percent even after that. So basically the way that this is looking to me is that we should see unconfirmed highs sometime, good quality fully unconfirmed highs sometime this month or early next month. But it's also possible that can extend into June or July. I don't see how it can go past July, just to be completely frank with you. So I believe we're dealing with a situation which is going to reach an untenable level sometime in the next, I think, 3 to 6 weeks and maximum 2.5 months. And I would say I don't put the odds at 2.5 months that high, but central bankers and central planners are having a field day right now, so you don't want to.
You have any upside targets that you're looking for?
Yeah, I'm going to show you. Basically, what we're dealing with on this chart right now is showing several indexes. We're showing the S&P, the transports, and the Dow. And as you can see, the Dow has cleanly broken out over broadening pattern high. And when these things happen, they just don't stop. They just don't say, oh yeah, it's an overthrow, we're just going to reverse right now, especially when the S&P has done it in this way. So the S&P has made extremely clean breakout over this broadening pattern. And to me, that is either incredibly bullish.
Yeah, a couple of successful retests of the throw over.
Yeah, so either this is incredibly bullish and it's going to go on forever and indicate a new bull market lasting for 12 years or something like that, or 5 years or whatever, or it's a part of a larger throwover. My belief is that we're in a part of a larger throwover, but I'm open to that. I take it one step at a time. I might
Okay,
have an
how
idea
about this
about
for
that,
the,
but not
how about this
necessarily.
for one step, Peter? Closing back inside of the broadening top.
Yep. Closing back inside this broadening pattern would be deadly right now.
Okay. It looks like about
So it's
3,800.
important that people take a look at this 3,800 area, 3,820 area presently, which is, you know, rising pretty fast. And below 3,850, the market's in very deep trouble.
Okay, cool. Got it.
And this is an important chart because this is a very long look at the Dow. And as you can see, this red line has been a key trend line. Now, one of the things that happens when you get into declining quality rallies is you don't actually get to the top of a trend line, you get close to it. Believe it or not, I think it's possible for this blow off to take the Dow up another few thousand points, possibly even more, maybe 10,000 points. And that would then create an adequate failure potential at this red line. You can also see a large broadening pattern here on the Dow that bottomed in 2020 and that we have bounced off of. So these are, you know, not inconsequential patterns. It's something to keep in mind that in a running extended wave, we can go further than you think, even if it doesn't make any sense at all. Okay.
Yeah. The rubber band.
Yeah, this is what I'm looking for, but I'm not married to. I want to be clear. Okay. What I believe is that we are looking at something in April where we make quality unconfirmed highs. So you can see that here.
Yeah.
And those would be likely to be coming with a throwover on this pattern, since markets need something emotional. The targets on this roughly are about 41.60. If you've been following me, you know that my minimum target was 40.30. But I felt like that the target area was probably between 40.30 and 41.60. And so if you put 41.60, handicap it and say 4,100 right in the middle there, then plus or minus 200 or 300 points from there seems to be not 200 or 300 points, but say 200 points. We could extend over that by 200 points pretty easily. So I think, you know, 4,300 is possible. I don't actually think we get there. I think it's more like this, but you know, you never know. But it looks to me like we're dealing with something, you know, in April, OPEX is probably a very good time, April OPEX, to look at the market, putting in some pretty unhealthy highs. This is an example of why I was talking about confirmed highs. These are two very important indexes, the Composite Sentiment Index, which is at the top, and the credit versus equity sentiment. And basically what happens is that when you have very negative credit sentiment versus equity sentiment, you're going to get squeezes in the market at some point. Now, it's important to qualify that because the you know, the market doesn't have to bounce immediately, but the point is that on this chart, you can see every time we have confirmed highs, which are the little arrows on this chart, like for example, here, this is a confirmed high, 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 and now we have a new confirmed high. Every time we get a confirmed high in the Composite Sentiment Index, we're going to get follow-on highs. And what I'm looking for is to see something more like this, like right in the center of my screen. That is what we need to see combining with a high in order to, in terms of sentiment. What we're seeing right now is kind of the opposite. If you look at credit sentiment has dropped further since I made this chart, which is what I was anticipating. So it's dropped a little bit further.
Because of yields going up, Peter? Is that why
it's
it
not
dropped?
about yield. No, this is emotions. This is
All right,
market
credit.
emotions. So,
Okay. All right.
so the credit versus equity, it's not even sentiment of credit. We're talking about the disconnects between equity and credit
Correct.
in terms of emotions. And when you get a very high amount, now this is too high. This is too much pessimism here. So the market, for this pessimism to matter, we would need to be making confirmed lows. So that means that our I'm sorry about the noise here. Our market would need to be pulling back into a situation where we would be seeing a lower low relative to the same lower low emotionally. Otherwise, what's happening is that people are selling the lows, expecting the market to break down, and they're going to get predictably squeezed. So what you can see in every one of these green arrows here is that we have extreme imbalances between emotions in the credit versus equity sentiment, and we have higher lows. And each one of those results predictably in very strong squeezes. So that is what we have here. Therefore, I am thinking that we have a good chance of exceeding the 4160 target by some degree because emotions are completely imbalanced. Now, if you look at when I made this chart, right after I made this chart, we came back down and had a pretty decent test, and people, of course, getting quite bearish. But the problem is the emotion imbalances will not allow basically the people who are betting wrongly are too much on the fence to actually get control of prices. And so, you know, we're going to continue to have squeezes higher until this changes, in my opinion. Also, on this chart, we can see that basically right over here, we had extremely strong emotions. Again, this is a trend. This is not a pure emotion measurement, but it's a little bit emotional. We had some, this is a trend index that I use. It's not the standard one. And you can see, you know, very strong emotions there. So we have a very important price level, basically in the 3,800 area. This is the shelf for the market that's going to be defended. Even when we go down, that area is going to be defended in a big way if we start to, you know, move towards it. This is another reason I think the markets need to go higher. The options players are speculating in out of the money options that they are buying in expectation of trying to protect themselves. And what I have found in general is that when you have a very high amount of activity and people trying to,
insurance or puts.
If they're trying to buy insurance, they have to get squeezed out of their insurance first before the market turns. And I want to just give you an example. It might not look like that's what happened, but look at what happened here. Okay, what you can see is that people were buying all the insurance in before the market advanced and then had none when it advanced, and they bought all their insurance at the lows. If you look at it here, look at what they did. It doesn't look like it. Most people look at these charts incorrectly. So what happened is that people basically took all their insurance off the table before the market topped.
Right.
These
Because
out
it's
of
a
the money
waste
options,
of money. Because
yeah,
it's a
these
waste
options
of money.
need to expire worthless, and the people need to relent on them. What they're doing right now is adding to them. So this is not healthy for the idea that the market is going to turn around and go down right now. I wish it was, because I think this whole thing is an exogenous, dangerous situation. But you can see the same thing here in a different way. We have a very, very low put-call ratio. So we have now a disconnect. We have people buying tons of protection and at the same time wanting to have lots of calls. So we're setting up a very extreme environment. And I'm going to go through that in another chart, which is very important, because at the same time, people are buying an enormous amount of puts. And this is not going to work. So I think we basically have to hammer all of these open derivatives positions before the market can relent. We're just wafting between the imbalances between them right now. This is another chart that I've been watching and presenting for a long time, even though most of my work is just pure emotions. Occasionally, once every several weeks, I do a look at the markets in terms of broad charts, and then I look at charts like this, although I monitor them like once a week, twice a week, 3 times a week. This is Dow Jones Mortgages chart, and basically what we need to do is to come up and test this gap area, and I've been talking about that for quite some time. And I believe that's an area where the market will look to make a psychological decision, because, as you know, about 20% of mortgages are in some sort of form of default, and we have forbearances which will be coming due, and when they do, that's going to send that number even higher. But we have this huge optimism about how everything's just going to work out fine in mortgages.
Well, housing prices keep blowing off. There's a mad rush. People are offering cash above the listed price and competing for homes everywhere.
Yep. And this is an important chart. This is my projection of future volatility. Basically, plus or minus a few months. We're looking at low volatility right now, and that volatility should turn. I'm looking at this as fairly impending. So in other words, looking for a Q1 kind of low, Q2 low in volatility, and then a bear market. So this is projecting out to a situation in which the implications are longer term. We're talking about a 3 or 4 year bear market type of thing, if this is correct, which I believe it is. As you can see, I've been posting these and related charts for a very long time, and they have been quite accurate. This is another very important chart I've been posting for a very long time, and this is the Euro chart.
Yeah, you thought we'd go back up and retest the high, Peter?
I still think that the Euro will have to test this channel again before it kisses it goodbye, but I'm not married to that. I'm not married to that at all.
I don't think it will.
As you know, I have been cautioning about the dollar situation for quite a long time. So I am extremely bullish on the dollar, and I'm extremely bearish on the euro. So essentially what we're looking at is the euro likely to drop to around the price that it was issued. So 0.8.
I remember that.
Something like that.
Yeah. Wow. Okay.
And
so I'm thinking, Peter, let me get a word in here, that with your blow off scenario that you're painting, that I really didn't think it was going to happen. I'm actually looking for maybe the dollar to peak, or it has peaked just short term for a pullback to 92 or so in the Dixie. And that's the environment where risk can go, should give us some jet fuel to get to your upper numbers with the dollar pulling back.
I would agree with that. I would agree with that.
All right. Well, another great interview, Peter, and some interesting things. You want to
one or two more charts? Do you have time for them?
Well, yeah, quickly though, because they start another webinar in about 15 minutes. So,
Okay, well,
yeah.
I'll make it very quick.
Okay.
Basically, here's a popular chart which has been being posted incorrectly of the Nasdaq. We have this huge fork that has been going on in the Nasdaq. The Nasdaq is not at the fork; it has broken out of it. So this is going to require more effort to turn it down than what people would normally imagine. And then these are the last and very important charts. This is what I'm looking for the New York Stock Exchange to basically come up and retest this resistance area and potentially overthrow it slightly. This is the options chart. The purple line on there that I was talking about is the institutional index put option buyers. They are very pessimistic, extremely pessimistic, and markets don't make highs when this is going on, in my opinion.
Okay.
This is the last one. This is the transports. I've been posting this one for a very long time. I believe we did that last time. And we are now in the overthrow phase, which I think should conclude relatively soon. The last situation is bonds and equities have a relationship, but it's not the relationship people think. I've seen incredible misinformation posted about this relationship between bonds and equities. This chart covers that. If people want to take a screenshot of it, they can look at it further. I believe we're looking at something like this right here because of this relationship, okay? And then this is the last situation in terms of breadth. The highs were confirmed, although we are putting in patterns very similar to this. So I think the market is putting in the platform for very important inflection point coming up. And then this is the last one. Just the VIX is very similarly to prior to March.
Yeah, we filled the gap. Finally filled that gap, Peter, at 1820.
Yeah, and then this is the last chart.
You have a number for a VIX where you think it could go to in a blow off?
I've been looking for 18 and a half on VIX to, but I wouldn't be surprised if it wants 16 or something like that.
16. Okay.
These are the two measured target areas that I am looking at for the market. The thick one is the primary one, but the less thick one is also viable. And this is the last chart. Okay. I posted this. This is a very good chart as far as I'm concerned. Basically, we are channeling here. We need to get this momentum indication to hit the top of the channel, which I think it will. It doesn't need to do it perfectly, but I think it will. And that would result likely in something like this. So this is where, my summary is. And let's see. Just recently, this is as of yesterday, I had been posting about this line here, this big, thick end line, third end line. That is a large fractal cycle resistance level, and they are bearish. And as you recall, I was bearish right here for a pullback. We got that pullback, and I suggested that if we broke out of that line and it held as support, we would be getting an impulse higher. And I just want to share that we have held support. We also have had internal trend oscillation, which is an emotional measurement, hold 0. And therefore, it is going to take some time if this impulse is successful to unwind it, which means that we need this to go up until we get termination and dissipation cycles, which are called bullish retracement to end, and then usually to second end resistance cycles. So that's my overall picture here. And this was from this morning. As you can see, this played out. So these are charts I posted MCM on MCM CT Markets. And
that's where you could find Peter on Twitter at MCM. It's underscore, right? Or is it hyphen?
Yeah, MCM_CT is the public site where I'm complaining a lot about the situation we're in. And the markets only site is MCM CT on MCM CT markets.
So Peter,
And
thank you much.
that's a members site. So if you want to join that, you have to click on the link at the on the top of the profile, and then you can register and sign up.
Okay, so that's how you both follow and join Peter in his endeavor of looking for emotional disconnects and reconnects. And I want to thank you, my trading warrior brother, for sharing your work with us today. And
Thank you.
we'll do it again, buddy. And I hope that all your forecasts work out and that many participate. So good hunting. Good hunting, buddy.
Well, I just found a head's penny, so I think that kind of is good.
Okay, and stay in Boca for a while.
Okay.
And all right, no traveling
Okay.
for a while, buddy. All right.
Yeah, no more lockdown.
I'll
Okay.
talk to you soon,
Catch you
Peter.
later. Bye-bye.
All right, see ya. All right, that's a wrap, everyone. Hope you enjoyed Peter. Some very esoteric stuff pointing towards something that could be developing here in the next month or so. That's a wrap for us today. Don't forget to join the whole team for the Morning Edge in about 9 minutes. You're very welcome, Alex. And tomorrow is NFP. There will be a webinar. So adios, everyone. Don't just count your pips, count your blessings. This is your host, Dale Pinkert, saying later, man. See ya.